Welcome back to our Balance Sheet and Financial Position series. In Part 1, we covered the fundamentals, walking through the basic structure and formats of the balance sheet. We established the foundation for understanding how a company's financial position is presented and organized. Now, in Part 2, we're taking it to the next level. Today, we'll dive deep into advanced concepts that are critical for the CPA exam. We'll explore asset and liability classification in detail, break down the components of stockholders' equity, and most importantly, I'll show you the common traps and tricks that the CPA exam loves to test. If you're preparing for the CPA exam and want more strategies, tips, and detailed breakdowns like this, make sure to subscribe to the channel. Let's get started.
So we covered the balance sheet formats. Now let's dive into details of the classification, and we are going to start with current assets. Those are very important, not also for the balance sheet, but also for the liquidity ratios that we are going to see later. So what is a current asset? This is a well-known definition. Those are the assets expected to be realized in cash, sold, or consumed within 1 year or the operating cycle, whichever is longer. And this is one topic that we all know, that what is a current asset, but we always forget the operating cycle, and the exam likes to ask that. So let's say if a company's operating cycle is 18 months, and then if they have an asset convertible within 18 months, it still goes as current. But for most of the companies, we usually stick the 1 year rule. The most common ones are here, cash and cash equivalents. What are they? Currency demand deposits and short-term liquidity investments. They will mature in less than 3 months. Our short-term investments, they are available for sale, expected to end sold within 1 year. Accounts receivable. Accounts receivable is a current asset, but net of allowance for doubtful accounts. Inventories, it's a current asset. It is reported at lower of cost or market. Prepaid expenses are payments made in advance for services, what could be maybe the prepaid insurance, prepaid rent, and they are current. We classify them as current if they are used within a year. Example, let's say maybe we have a prepaid insurance expense for 3 years. So anything the next 12 months is going to be a current asset. Okay, we are moving from short-term to long-term, which is our non-current assets. Those are the resources that provide economic benefits beyond 1 year or an operating cycle. Logical. So we break them into 4 different categories. The first one is our long-term investments. Those are the investments held for strategic purposes, not for quick sale. One example could be maybe like the land held for speculation, which exam likes to ask. Our special funds, such as like a pension fund or sinking fund, would be included to that. The second group is the property, plant, and equipment. What are these? Those are the tangible assets used in the operations, and we must remember that they are always reported net of accumulated depreciation. So those are always reported net of accumulated depreciation. Of course, there's an exception here, which is the land. Why? Because we do not depreciate land. The third one is the intangible assets. What are those? Those are the assets like patents and goodwill. They are non-physical but valuable for the company. Yeah, I cannot change the pen. Perfect. And finally, the other assets. So this is basically catch all for the miscellaneous long-term items. That could be the long-term prepaid expenses, deferred tax assets, or non-current restricted cash. Okay, now let's move to current liabilities. Just like the assets, we classify liabilities based on 1 year or the operating cycle rule. What are current liabilities? Those are the obligations that require settlement within that short-term period, typically requiring the use of current assets. The most common example we can think of are the accounts payable, accrued expenses, unearned revenue, and the most critical part is the concept there's a current portion of the long-term debt. This is the portion that you may see in the exam. They love to ask this one. So basically, any portion long-term debt that is due within next 12 months becomes the current liability. One other thing is the short-term notes payable also in the current liability. Okay, let's move to non-current liabilities. Those represent the company's long-term financial structure, meaning they are not due within next year. Those are bonds payable, long-term notes payable. Probably the most common one you may see is the mortgage payable here, where the promissory notes mature more than a year. Lease liabilities, the same way, those are the obligations, lease payments greater than 12 months. For lease liabilities, it recognizes both finance and operating leases. We have a catch-all section, which is the other long-term liabilities. Those are the pension obligations, deferred tax liabilities, and asset retirement obligations. Not very common even for the CPA exam. Here's a key concept. If a company violates a covenant, long-term becomes current. Basically, it becomes callable. In the exam, they're not going to tell you current, but if they say callable, it becomes current. One other key takeaway from this slide is that the same thing applies from the previous slide. As long-term liability approaches maturity, you must classify the portion due within next year as current. Okay, so we are in the stockholders' equity section. Just to repeat the definition we had earlier, stockholders' equity is the residual interest. Basically, it is the amount left for the owners after all the liabilities are paid. It has 4 sections. Those are the contributed capital, the amounts invested by the shareholders. This includes the capital stock, both par value or additional paid-in capital. The second one is the retained earnings, the cumulative net income or loss retained in the business after all the dividends are paid. So you can see from the name the earnings that are retained goes here. The third one is the treasury stock, which is the contra equity account. Basically, the shares repurchased by the company. One real life example you may remember during 2020 and 2021, when the interest rates were very low, a lot of companies purchased their own shares, so it goes on their balance sheets. I think Meta was one of them. It goes as an equity account in their shareholders' equity section. And the non-controlling interest, this one is reported in the consolidated balance sheet, so it's basically the equity subsidiary not attributed to the parent company. So maybe, let's say the parent company is Alphabet, Google's parent company, and they have many of those child companies. One thing I want you to pay attention, and we are going to have a separate class for this, but basically the accumulated other comprehensive income, those are the gains and losses not yet in red income. For example, unrealized gains on available for sale securities or foreign currency transactions. This bypasses the income statement. We just covered the components of equity, but now let's cover something that almost guarantee that you are going to see something in the exam, which is the treasury stock accounting. It's a little confusing and they like to test it. A lot of students think that treasury stock goes to an asset, and the logic is very simple. You say, okay, the company paid its own money and purchases stock. So normally when you purchase a stock, it goes to the asset section. But in this case, because it is the own company, like the company ABC buys the stock of the company ABC, they cannot own itself. So like those stocks the company buys becomes dormant. Those stocks do not have voting rights, they do not pay dividends. Maybe they keep more control inside the company. Maybe the company thinks that the stock price is going to increase, so they want to buy it. But basically, because of those reasons, it goes to the equity section, but it goes also as a contra equity because it is not an asset. So how you can see it in the exams, all you have to do is move it to the equity section. Treasury stock is a contra equity account, therefore it is going to be in the debit section. When we move it to the equity section, we have to reduce the total equity because equity increases on the right hand side as a credit. This is a little confusing. We are going to do a couple examples here. If you cannot remember anything, just remember that treasury stock is a contra equity, it is debit, and it is shown in the equity section of the balance sheet. Now let's address the broader presentation rules of offsetting. So this section is like the logical, we all know it, the offsetting is usually not allowed. We must show the gross amount. We cannot net accounts receivable against accounts payable and show only the difference on the balance sheet. Everything is separately shown there. However, there is a rare exception and the exam likes to ask that. You may see like the derivatives and the repos, which is called the right of set-off. So what is that? So basically, if those four conditions meet in the presentation, we can offset each other. What are those? Number one, they must be determinable amounts. So we know how much each party each other. Right to set off, they have a legal right to each other. They have intent to set off, both party intends that. And the enforceability, like this is enforceable. So one example could be, let's say we have a vendor and we bought a product from them and owe them $100,000. Then maybe we provided a service to them or we returned a service like something like that, and then that created a loan from them to us for $30,000. So instead of showing them separately, we can net each other because all four of the conditions meet here. This one is important because they like to ask it. What if not all the four conditions meet? Can we do it? The answer is no. One easy example could be, let's say you have a deposit account in a bank and you also have a loan in the same bank. Can you offset them? No, because the deposits are subject to insurance. The loans are not. They have different rules. So in the exam, if you see something about offsetting rules, you need to think about the four rules and all four of them must exist. The proper classification of current and non-current items are essential because it directly impacts the two critical liquidity metrics, net working capital and current ratio. Working capital is simply your current assets minus your current liabilities. This measures the dollar amount of short-term liquidity buffer available to the company. And the second one is the current assets divided by the current liabilities. And it measures the ability to pay short-term obligations. Our target is more than one. For example, if the number is 2, that means for $2 of every asset, we have a dollar liability, so we are healthy. If it's the other way around, we have more liability than the asset, which is not healthy. The exam usually tests your ability to calculate these metrics and interpret the results. The one key takeaway here, the high ratio is good, but also excessively high ratio can suggest that inefficient use of cash or inventory questions. Now let's do a practice question. We have a Summit Corporation and they've reported some account balances at the year ends. So at a particular date, remember it is the balance sheet, and they're asking us their total assets. Okay, so let's go over one by one. Cash, Cash is an asset, so we have $60,000. Accounts receivable is also an asset, $25,000. Treasury stock, remember I told you they always like to put it there, and we all think it is an asset, but it is not. It is a contra equity account we are not putting there. Property, plant, and equipment, it is also an asset. Accounts payable, it is a liability, it does not go there. So we have 60,000 plus 25,000 plus 20,000, and the answer is 205,000. Here we have another question for liability. On December 31st, year 1, PEX Industries has 2 million note payable. It is due August 1, year 2, so less than a year. They intend to pay the note using the cash from operations. Since it will be settled with the current assets, which is the cash, it is going to be the current liability. Okay, now let's do another question that is about refinancing and how it affects the liabilities. On December 31st, year 1, Titan Manufacturing has an $800,000 short-term note due March 1, year 2, so in 3 months. We have a note due, which is our current liability. However, on January 20, year 2, before statements are issued, Titan refinances the note with a 5-year loan. So they are basically asking how they should be classified on December 31st, year 1 balance sheets. Here we pay attention to, okay, so we see that January 20, year 2, they refinance it before the statements are issued. So this could be a little confusing here, so think this way. The balance sheet date gives us the snapshot of December 31st. But most of the time in companies, there are a lot of moving parts. It takes time, sometimes weeks to get the balance sheet ready. So basically here they are telling us we are going to prepare the balance sheet for this company after January 20. By the time we were preparing it, we knew that we already refinanced it. So how are we going to report it on the balance sheet? The answer is the non-current liability, because under the US GAAP, the short-term obligation can be reclassified non-current if the company has an intent, which they did, they wanted to do it, and they have ability to refinance it, which they demonstrated by actually refinancing before the financial statements were issued. This is one of the trick questions, but here they meet all the conditions. Now, let's go over the common exam errors and the traps. The first one is the treasury stock. It is not an asset. It is a contra equity account, a negative equity account. If you see a treasury stock, think about it, it goes to a contra equity. The second one is a restricted cash. So you may see questions that talks about the restricted cash, and usually we think it's a cash, so it's a current asset. But if it goes to a bond sinking fund or it is restricted for some other purposes, that means we do not have access to it, so it is not a current asset. The other one is the bank overdraft. That's basically about the offsetting. You may see more in the simulations. If there are bank overdrafts in the same bank, same account, you can use the right to offset. Most of the time, you are not going to see that, so they are current liabilities. I consider overdrafts as current liabilities, unless there is a right to offset within the same bank. The other one is the refinancing intent. The previous slide, remember the company had a $800,000 current debt, but they were able to refinance it before the balance sheet date. So we moved it from current to non-current. Sometimes they do not have both intent and the ability to refinance. It is not shown on the exam, so make sure that you see both ability and the intent to show it. The balance sheet doesn't exist in a vacuum. It's a part of fully articulated set of financial statements. And understanding this connection is crucial for the CPA exam because it helps you to verify your work and understand the flow of information. The most direct link is the income statement. Net income is the primary driver that flows into retained earnings on the balance sheet. The statement of cash flow is also directly connected. The ending cash balance of the cash flow statement must perfectly match the cash line item on the balance sheet. Finally, the statement in the changes in equity. This reconciles the beginning and ending balances of every equity account in the balance sheet. This interrelationship called articulation, this ensures that all the statements are internally consistent. So if your numbers don't tie out, you know that you have an error. This is a great way to check your work on the exam, especially in the simulations. And that could definitely mean passing and failing for you. Okay, we covered a lot of grants. Hopefully you learned a lot and you feel ready to take some of the multiple choice and simulations. One thing remember, the exam does not test your knowledge. It in the end tests your ability to take the test. There are certain type of questions being asked and you should understand if there's a trick, what kind of trick and how to solve it. It is a process. I know it is not an easy one, but the reward is also very good. Good luck on your CPA exam. Thank you.
Thank you so much for watching this deep dive into the balance sheet and financial position. I hope this breakdown of advanced concepts, classification rules, and exam traps has given you the clarity and confidence you need as you prepare for the CPA exam. If you found this video helpful, please give it a like and leave a comment below. Let me know which topics you'd like me to cover next, or if you have any questions about what we discussed today. And don't forget to subscribe to the channel so you never miss our upcoming lessons and exam strategies. Remember, mastering these concepts takes practice and persistence, but you're on the right path. Keep working through those practice questions, stay focused on understanding the underlying principles, and trust the process. Best of luck on your CPA exam. You've got this.